Good day, this is Shauna Casey, and welcome to this SOS educational webcast, Basic Training, a day in the life of a stock admin. Due to the large number of attendees, no conference call service is available for this webcast. The sound will broadcast through your computer speakers. However, if you wish to ask a question at any time during the presentation, please feel free to type it into the questions and answers panel of your GoToWebcast console, and we will do our best to answer them at the end of our presentation. Any questions that we don't get a chance to address, we will follow up afterwards in an email. This morning we sent an email with a link to the presentation materials to everyone that registered as of 10 a.m. this morning. You can also find the link to the materials under the Event Resources tab under your GoToWebcast console. This session will also be recorded, and we will send a link to the recording of materials in the next day or two. I hope that all of you are familiar with Stock and Option Solutions, or SOS as we are more commonly known. For those of you who are not, SOS is a leading stock administration staffing, consulting, and outsourcing firm within the equity compensation marketplace. SOS provides interim and permanent placement, expert project resources, and total outsourcing solutions. To learn more, you can visit us online at www.sos-team.com or call us at 408-979-8700. Next, I'd like to introduce you to our speakers for today's session. We are pleased to have Sally Fivecoat of KLA-Tencor Corporation and our own Carol Rose-Guerin and Catherine Randall on the panel today. Next is our standard disclaimer slide. We'd like to remind you to consult your own advisors before making any changes. As I mentioned, the materials are available on our website, and here again is the link. Thank you all for joining us today, and with that, I'll turn this presentation over to Carol, who will introduce our topic and cover the agenda. Thank you.
Well, good morning, everybody. We're glad that you're on the line to join us today. What we're going to be covering are stock options, restricted stock units, employee stock purchase plans, financial reporting, and then we'll have a question and answer session at the end of the presentation. And as Shauna had said, if we don't have time to cover everybody's questions today, we will go ahead and cover those by email afterwards. Someone from SOS will be responding to you. So the first topic today is stock options. But before we delve into that, I wanted to go back and talk a little bit about general background on stock options and restricted stock awards. So when I first started in stock administration, and I'm certainly not going to tell you what year that was, there was no such thing as restricted stock units or performance units. For U.S. employees, the predominant stock option was the incentive stock option due to the potential tax benefits of exercising and holding the shares. And I'm going to get into a little bit more about incentive stock options and holding periods in a little bit. Most international employees at that time were awarded non-qualified stock options if the company granted options internationally. Not all companies did. When restricted stock units came about, they became the prevalent stock award type for a large number of years because there was no exercise price associated with them. They could not be considered underwater because of no option exercise price, and the taxation and any profit was based on the fair market value on the day of release. Right now, I believe we're starting to see a resurgence of awards of stock options in addition to RSUs or performance units. Incentive stock options, I have found personally, are extremely popular for privately held companies so that employees can exercise the shares and hold them for the holding periods. Then when the company has completed their IPO, employees can sell the shares and obtain tax benefits if they have held the shares for the 2 holding periods, which we're going to discuss in just a minute. So let's go ahead and move on to what is a stock option. It is a legal agreement with your company that awards employees a specific number of shares to vest or buy at a set price. Usually the price of the grant is the market value of your company's stock option on the date the option is awarded. There are two types of stock options, as I've said previously, an incentive stock option and a non-qualified stock option. An incentive stock option really only should be granted to U.S. employees as it confers some tax benefits on the profits provided certain holding periods are met. So what are those holding periods? When you exercise the shares 2 years from the grant and the sale of the exercised shares, excuse me one moment, 1 year from the exercise date and from the sale date. For the profit on the option to qualify as long-term capital gain rather than ordinary income. The tax rate on long-term capital gain, generally speaking, is less than the ordinary income. And I know everybody out there doesn't want to have to pay tax any more than what they have to. So generally, if you're granted an incentive stock option or your employees are granted an incentive stock option, they usually do hold them for those holding periods. Now, a non-qualified stock option doesn't qualify for these tax benefits. And I'm going to get into a bit more detail about the taxes associated with stock options a little bit further in the presentation. So who decides what type of options are granted? That's your board of directors or the comp committee of the board of directors that decides the policy for the company. What is vesting and how is it applied? Vesting is the amount of time from the date the option is granted to the date the option can be exercised or the shares bought from the company. A company usually has quite a few different types of vesting templates. For example, your company may require holding the option for 1 year before an employee is able to exercise a portion of the shares. Or for some companies, they may require the employee to just hold it for a quarter. It depends on what type of vesting schedule is provided to the employee. So what does it mean to exercise a stock option? As we've discussed a little bit, it means to buy the shares at the price specified in the formal option agreement. What are the different types of exercises? Well, payment of the shares and any taxes associated with the exercise can be paid by cash, or there are other types of exercises where employees do not have to use their cash, and those are the most popular with employees. There is sell to cover and sell all through a broker. What that means is that you can arrange for your employees through a broker to decide what they would like to do at the time of exercise. They can either exercise all their shares that are available and sell only a portion of them to be able to cover the tax due on the exercise and the exercise price. Or they could sell all through a broker. There's also withholding of shares if your company allows that to cover the cost of the exercise along with the taxes. Can employees pay cash for the shares? Well, yes, they can. We've already talked about that. Is the transaction taxed? Yes, it is. If you're a U.S. employee, you'll be paying federal tax, Medicare tax, state tax, and if you've not maxed out on your Social Security tax, you will be paying that also, along with any state disability insurance tax that your state may require. What's included on the annual W-2? Well, the profit from the exercise as well as the payment of the taxes will be forwarded to your payroll department, who will then be required to include that information on your W-2 at the end of the year. For international employees, each country has their own tax rules which your company is required to follow. And we would recommend that your company contact either their outside legal counsel or perhaps maybe someone in your company would know what the requirements are to determine the correct percentage of tax on exercise on any of the profits required to be withheld and reported by your company. Mobile employees. Mobile employee taxation is extremely complicated, so we're not going to delve into it in depth here during this presentation. However, the IRS is beginning to scrutinize the withholding and reporting on exercises and RSU releases also for both state-to-state and country-to-country mobile employees. And again, we recommend that your company contact their legal advisors to determine the percentage of tax on exercise profits required to be withheld and reported by your company. Okay, let's talk a little bit about restricted stock awards. What type of awards are there? Well, it depends on basically what level in the company you're at or what level the company would like to provide to you. What I have found is the executives in the company, most of them have performance stock awards rather than just restricted stock awards. Performance awards are based on the actually the performance of the company. What will happen is they will go ahead and put up special restrictions on the award that the company must maintain a certain percentage of profitability, that type of thing. Generally, rank and file employees are not required to do that. They go ahead and receive just restricted stock awards. And all they have to do to obtain a restricted stock award most of the time is to maintain their employment with the company. Who decides what type of awards are granted? Well, again, that's your board of directors and also your or it could be the comp committee of the board. So what happens when the awards vest? Shares are released to employees based on the vesting schedule. Again, that's in their formal agreement. Just like a stock option has a formal agreement, so do restricted stock awards and performance stock awards. How does the release of shares work through a broker? Well, shares can be sold to cover the taxes associated with the release, or all of the shares can be sold. The broker, as the same as the exercise of a stock option, the broker then forwards the amount of funds to cover the taxes to your company on the employee's behalf, and the remainder of any cash from the sale is usually deposited into an account at the broker for the employee. Your company may also allow withholding of shares to cover the tax, and those taxes would be paid into various agencies by the company payroll department. What is vesting and how is it applied? Vesting is the same as for an incentive stock option or a non-qualified stock option. Your vesting schedule is for each employee is contained in their formal agreement. What does an employee have to do to obtain these shares? Generally, the employee only has to stay as an employee of the company for rank and file employees. For executives, yes.
I have a comment. This is Sally, and I have a comment on the vesting for this RSUs or restricted stock awards.
Okay.
I worked for a company that was very slow to switch over to restricted stock, and we learned from other people's pain so that we, when we granted RSUs, we had quarterly vesting dates. That doesn't mean we had quarterly vesting because that's way too often for an RSU, but we had one date each quarter where our RSUs could vest. And what that does is it centralizes or gives you one point in time each quarter where you have to do all the administrative work for an RSU vesting. And so even though we had annual vesting, we just hit the same target date each quarter to have our vesting events occur, and that really simplified things instead of having multiple vesting dates each quarter.
That's a great comment, Sally.
Yeah, I would say that, this is Catherine here, I would say also most companies are trying to consolidate it to no more than 1 day a month, if either monthly, like on the 15th of every month, or the 15th of the second month of every quarter, or there are some companies that do it once a year on their annual merit option or grants. So it does make things a lot easier on the administrative side.
Yep, it sure does. Thank you, ladies. Okay, so restricted stock award. Is the transaction taxed? Yes, it is. If so, what type of taxes? Think of it for rank and file restricted stock awards, you can think of the taxation almost the same as a non-qualified stock option, with the exception that there's no option price on a restricted stock award. So the profit is going to be based on the difference between $0 and whatever the market value is on the date of the release of shares, and that would be the amount that's taxed. What's included on the annual W-2? It would be the same as for options. The information is reported through your payroll department. It would be the gain on the transaction along with the taxes that are collected on the transaction. International employees, the same as for options. Again, we request that you contact your outside legal counsel to just ensure that you are using the correct percentage of tax on any profit for the release of the shares. And mobile employees, the same thing. It's a really complicated topic, and it's not anything that we can delve into here because some states have reciprocal agreements on state-to-state mobile employees. Some countries have reciprocal agreements. So a lot of that is going to depend on what states and what countries in which you have the employees. So at this time, I'm going to go ahead and handle the presentation over to Catherine, who's going to talk to you a little bit about employee stock purchase plans.
Hi, everybody. This is Catherine. We are going to talk about everybody's favorite thing, the employee stock purchase plan. The employee stock purchase plan is a type of stock option that allows the employees to purchase company stock over time through payroll deductions. So you might think of it as, similar to a stock options that are more tightly regulated, and everybody participates together at the same time. The most commonly used ESPP plans in the U.S. are written to qualify for the Section 423 of the IRS Code. And that's to get a preferential tax treatment and to try to promote people holding on to the shares. To qualify as a 423 plan, there's certain requirements that must be met, and I'm going to get technical for a minute because this is the IRS and technical is what they do. Participation in the plan can only be granted to employees of the employer company or of its parent or subsidiary corporation to purchase stock. The plan must be approved by the shareholders within 12 months before or after the date that such plan is adopted. No employee may participate if immediately after the option is granted would own stock possessing more than 5% or more of the total combined voting power. Participation is to be granted to all employees of the corporation. If some employees can participate, all the employees have to be able to participate with allowable exclusions. Employees who have been employed less than 2 years are allowed to be excluded. Employees whose customary employment is 20 hours a week or less. Employees whose customary employment is for less than 5 months in a calendar year, and of course the 5% shareholders.
Catherine, just a quick comment. I think that it's extremely important that you understand your employee stock purchase plans, and my rationale for that is that not every company grants either options or restricted stock to all employees, and sometimes this is the only plan that the employees might be able to participate in. So it's really good to understand all assets and all parts of your employee stock purchase plan, because employees are going to be coming to you with a lot of questions on that.
Yes, it's also very important to pay attention to what plan your company has decided to pass. Read the document. Do not take someone's word for these are the rules. Go read it yourself. You'd be surprised at the slightest little thing that can get in the way. For instance, just because the law allows 20 hours a week, yes, you can be included in the plan. Well, if legally that might be the case, but if your particular plan said over 20 hours per week, that person has to be excluded. It's just a word. Some paralegal wrote it into a plan, but if it's in your plan, it's in your document, and your board passed it, that's what you got to live with. So be very careful to read your plan first. I'm going to get back to the various requirements for a 423 plan here. Under the terms of the plan, all employees who are participating in the plan should have the same rights and privileges, except that the amount of stock that they may purchase may be different, but it has to be a uniform relationship to the total compensation. So 5%, everybody needs to be allowed the same level of participation, not dollar amount, but formula calculation. The amount of the purchase price cannot be less than 85% of the offering date or the purchase date. Offering periods are limited. It can be up to 5 years or 27 months, depending upon how your plan has determined to calculate the price. Most plans these days have what's called a look-back feature, which is the lesser of the grant date or the purchase date, and then a discount from there. If that's the case, 27 months is the longest offering you can do. And under the terms of the plan, nobody can be granted the rights that will exceed $25,000 of fair market value of the stock on the grant date for each calendar year. The calculation of that is pretty tricky, and I'd suggest you go over that with your accounting and outside legal, because there are actually a couple different interpretations that have been used. Check your software, make sure you understand what it's doing on how it's calculating your 25K limitation. Under the terms of the plan, the option is not transferable. Basically, otherwise by will or laws of descent or distribution, it's exercisable during the employee's lifetime only by the employee. Any plan that does not meet these qualifications is treated like a non-qualified stock option. All right, so we're going to go through some of the terms that are used in the in the ESPP. An offering period is the employee during which the purchase rights under the ESPP are active, such as during a stock option, for instance. The purchase period is the period of time in which the contributions are being accumulated and always ends with a purchase date. There can be multiple purchase periods within an offering. Example, there can be a 24-month offering period with 4 separate 6-month purchase periods in it. The common practice these days, due to expense issues and changes in the rules, current common practice is about 6 months for offering period and for purchase period. Now we're going to talk about dispositions. When an employee eventually sells or otherwise disposes of their shares that they purchased through the ESPP, it's called a disposition. A qualified disposition is when the employee met the holding requirements of 2 years past the date of grant, 1 year past the purchase date before they dispose of the shares. If the shares were disposed of before this holding period was completed, then the shares would be disqualified from that 423 preferential tax treatment. And so we call it a disqualifying disposition. In the case of a qualifying disposition, the employee will recognize ordinary income, the lesser of, the difference between the fair market value and the purchase price at the date of grant, or the fair market value on the disposition date minus the actual purchase price. In the case of a disqualifying disposition, the employee will recognize as ordinary income the difference between the fair market value on the purchase date and the purchase price, which is the gain on the purchase date. Now I'm going to go over some basic common practices in the plan administration. Open enrollments. This open enrollment is the period of time during which the employees may enroll in the plan or make changes to their enrollment for the next offering if they're already participating. This is going to be laid out in the plan, in the actual language of the plan.
This is Sally, and I've worked for companies that have had like just a 2-week open enrollment period, and you have to send out all kinds of emails making sure that nobody misses that 2-week period. But I've also worked for a company that had their open enrollment period for a new offering start as soon as the current offering started. Then you were allowed to enroll in the next offering, and you could enroll in that next offering anytime up to a week or two before that next offering started. And I think the advantage of this is that new employees who are coming on, as soon as they have their account with your service provider, can enroll in the next offering of the ESPP, and that way they can't miss the open enrollment period, and already employed people can do this in advance. So if they happen to be busy or out of town or on business travel during the time of the open enrollment window, this just gives employees more flexibility, and it really doesn't seem to cause too much more headache for the plan administrator.
Yeah, I think having flexibility in the open enrollment period is pretty helpful for the administrators, although, again, this is language that goes into the plan, and so this is what needs to be, approved by the administrator of the plan, i.e. the comp committee or the board of directors. So once again, go back to your original documents, check, see how much flexibility you have with that. It is common practice now for open enrollments to be run through various web access systems. Some people still do the hard copy agreements, but employee communication is absolutely critical at this time. Get as much information out there to employees in the simplest step-by-step manner as you can through international websites, emails, webinars, seminars, even posters up in the hallways. Not all your employees are going to be really good on email or really attentive to various different communication systems. You really need to get it out there in multiple ways to get your employees to be aware of when the open enrollment is and how to get information on how to sign up. Contributions. At the end of the open enrollment period, you're going to gather up your enrollment data and set up your software systems and communicate with payroll the contribution rates chosen by employees. You want to take that data and review it very carefully because no software is perfect, let's face it. Use employee ID numbers or tax ID numbers to look for duplicate accounts, often caused by rehires, mobile employees. Sometimes names will be spelled differently, formal names, nicknames. You want to make sure you don't have any duplicate accounts. You want to make sure everybody who has signed up is actually eligible. Things happen. You want people change status. You want to check for this. Also look for recently terminated employees or newly reported employee leave of absences. Once you're absolutely sure your data is ready, then now you've got your participant list, your enrolled employee list. Disposition tracking. This is the responsibility. It is the responsibility of the company to report ordinary income generated by ESPP share dispositions. Tracking those dispositions can be done through surveys, which is the old-fashioned manual way, or by having the ESP shares maintained at a captive broker who can send you regular reports on the sales of the ESP shares. Dispositions need to be reported to payroll for inclusion in the employee's W-2s. Now we're going to talk about data accuracy and completeness. Once you've got that list of enrolled employees, there's some more information that you're going to need to add to that. At the end of each accounting period, month, quarter, whatever your company does, you'll need to go through your data for accuracy. You will need to do this prior to the purchase date as well. The following accuracy checks are good for both. You want to review terminations in your records against HR records and resolve any discrepancies. Check those international payrolls because sometimes information takes a while to get back to the main office. You want to review with HR if any of the enrolled employees have changed their status from full-time to part-time. If they're going below 20 hours per week, they can no longer participate. You want to look for any leave of absence. Check with HR to be sure what is a qualified and an unqualified leave of absence, and make sure that anybody who should be withdrawn from the plan is withdrawn from the plan. Once your individual data has been reviewed for participant status changes, run an expense report from your system for the full offering if you have access to that, and review the total number of records against your total number of active participants. This test is best done at the beginning of the offering and rechecks done as needed throughout the offering. Your total expense records, that's just the number of records. Don't worry too much about what the calculation is because most often that's happening over in accounting. But your total expense records should match your total enrolled employees. And it should adjust down only for those employees who terminate with a company throughout the offering. Expense for terminated employees should show as either reversed or not show up at all as the offering goes through. All employees who withdraw from the plan should still show as expensing. If you want to be your accounting department's new best friend, you can do a quick manual calculation of the estimated contributions using the annualized salary, the contribution rate, and the number of payrolls that fall into the period that's being expensed, and then demonstrate that the software's estimated calculation is reasonable. They might bring you donuts for that, but international considerations. When the plan is drafted, very often it's set up in such a way to allow for non-423 offerings to run concurrently with other countries for other subsidiaries. This can allow for certain variations in the employment law in different countries. You need to investigate each country you want to extend your program to for issues before you open your plan to those employees. Some countries do not allow exclusions for part-time employees. Some countries do not allow payroll deductions, and other countries do not allow funds to be transferred out of their country. There are a multitude of these country security issues that may also need to be addressed. So make sure each country's laws have been thoroughly vetted before you extend your program to these employees. Same thing with tax issues. Make sure that you have thoroughly investigated how ESPP shares should be taxed in each country. You're going to need to be in contact with the international payrolls. How are you going to coordinate with payrolls the reporting of what the gain was at the time of each purchase, and if there's any tax withholding that's necessary, how is that going to be handled? You do not want to be dealing with this the week before the purchase period. Make sure that you know what you're getting into before you offer the ESPP in a country. So at this point, I'm going to turn us over to Sally for the financial reporting.
Thank you, Catherine, and good morning, everyone. So I got the topic of financial reporting, And I'm going to start with a point that Catherine made about the ESPP. But any reports that you provide are only as good as your plan data. So I recommend doing a monthly audit of your data to the HR database. And you want to look for new hires, which aren't as crucial, but you need to have your new hires in your system before they receive a grant or before the ESPP open enrollment period starts. But the most critical item is terminations. And you want to be sure that all terms have been updated in your data. It's especially difficult if the terms are entered into your HR system after the fact. This is very common I found in international locations. If you have an automatic data feed to your administration database, you need to be sure that it has a look back for terminations of about 30 days instead of just transmitting the data to your database on the date of the occurrence. And then if you have this 30-day look back, that's great, but then you need to let your HR team know that if they enter a termination that's over 30 days old, they need to let you know. And doing a quarterly look back, looking back each quarter when you do your reconciliation is also helpful. I also do a monthly... Yes.
Sally, I just wanted to interject here, and I can't say how extremely important both Sally and Catherine have said about terminations. I had a major problem at one company as far as trying to get the termination information, and then I actually did set up a monthly meeting with HR to sit down and go through data on both ends to try to eliminate this problem, and it actually did help. So again, all three of us are telling you how important it is that you do get your termination information in your system quickly after a termination happens or even prior to a termination happening. Because sometimes depending upon what system you're using for stock administration, there are certain systems which will allow you to put the termination information in either directly the day before the termination and upload it to the broker that evening, so that it's when you're uploading it the evening before, it affects the next day, and that would then go ahead and ensure that your employee is not going to be able to exercise an option that they're not supposed to, and other extraneous things. So I'm going to be quiet right now and let Sally go ahead and get back onto her presentation.
Hey, Sally, this is Catherine. I'm going to throw this out there just as a heads up to stock administrators. There is a new trend in the HR world to have softwares that the manager enters in the termination date. And if you have a large corporation and you've got managers all over the place who sort of know how to use the software and sort of don't and get around to entering that term date, maybe the following Monday or Tuesday, you could end up with shares released that shouldn't be released, shares purchased that shouldn't be purchased. So I'm just giving you a heads up out there. Sometimes contacting HR before a purchase or before a big release and saying, hey, what have you got coming down the pike? Sometimes that can help. Sometimes you just got to learn to fix it after the fact.
Thank you. That's great information. And also I have found that sometimes dates change. Termination dates can change, but I also had an issue recently with a start date that changed, and it was not entered into the system. The change wasn't entered in the system, and the person had been recommended for a grant, and by the time the quarterly grant date came, the person had not started, and he was still in the system. So all of those kinds of dates and changes can cause huge problems, and HR is often not aware that those problems, affect stock admin. So you need to have a really open dialogue with your HR people and make them aware that, when significant dates change or are entered after a fact, that you really would like to have a heads up, and that can be very helpful. So I also do a monthly audit of all activity. My software has an activity report, and I tie out all the grants, cancellations, releases, and exercises. And then there's also a category that's called adjustments, which can really be a headache. Hopefully you'll know about these before they happen, but sometimes your service provider will make corrections thinking that they're doing well, and it can cause you a lot of headaches. So let your service provider know, if you're outsourced, that you need to know anytime that they're changing any of your data. Also, you want to let legal and HR know if they're talking about making any changes to outstanding grants that you need to know. A correction for an administrative error shouldn't cause any accounting problems, but if it's actually a change, it may require modification accounting, and you'll need to get your accounting group involved. And then when you're providing information to these other departments, you need to know how often they're going to want it, quarterly or monthly. Okay, so the kinds of reports that your accounting group will need would be on grants, exercises and releases, cancellations, and adjustments, which we just talked about. Another type of reporting is Form 4 reporting. Now, the SEC requires reporting of ownership on Section 16 officers and members of the board. So your legal department will determine who your Section 16 officers are, and the board will need to designate them annually, or usually annually. Excuse me. All the board members are Section 16 reportable. The Section 16 reports would be filed by either legal or stock admin, but they should be, if you're doing them as stock admin, you should have them reviewed by legal and by the Section 16 reportable person. The reports are actually the individual's responsibility, but usually companies do the actual reports. The SEC requires Forms 3, 4, and 5. Form 3 is when a person is newly designated as a Section 16 officer, and it states their current holdings. The Form 5 is an annual report, and very few transactions qualify to be reported on a Form 5, but they can all Form 5 transactions can also be reported voluntarily on your Form 4, which is the thing I prefer to do so that they don't get left out at the end of the year and if you forget to do a Form 5. The Form 4 is the most difficult because the transactions that have to be reported on the Form 4 are the most numerous, and it must be your Form 4 must be filed within 2 business days of the transaction. The transactions that are reportable would be grants, except for performance vesting grants. Performance vesting grants will be reportable when the board certifies the performance that has been obtained. Also, exercises and releases, or also shares that are withheld or sold to cover taxes, those would be a disposition, and any other acquisition or disposition of shares. So some of those could be outside of stock administration's view, and that is where it's up to the reportable person to let the company know. Let's see. Other departments may need information as well. I know particularly tax departments need information, and those reports would be on any transactions that result in income to the employees. The only one that I can think of that has income to the employee that stock administration needs to report to payroll, but that the tax department doesn't need to see, is ESPP qualifying dispositions, because the company is not allowed to take a tax deduction for ESPP qualifying dispositions. one really important thing to determine before you send information to other departments is what exactly do they need in the way of employee identifying information. Because of all of the data privacy regulations, you don't want to be sending people's names, their social security numbers, to people that don't really need to see those, so that you will probably want to delete those from your reports. Sometimes your department, sometimes the other departments will need an employee ID if they have to do a VLOOKUP to find cost centers or something like that. But the best thing for you to do would be find out what information they need, try to include it in your report so you can take out any employee identifying information that they really don't need. Sorry, I was a slide. Oh, no, let's see. Sorry, I've gotten the slides out of order.
Sally, can you click on which slides you want there?
Yeah, I think I got a little bit confused. I'm sorry.
That's okay. No worries. I just don't want to make it worse for you.
Okay. So the annual proxy reporting is another area of reporting that you will be asked to provide information for. You will need to provide information on the NEOs and the board members, on their ownership and the compensation for the annual proxy. And the slide just changed. Let's see. No, okay, we're on annual proxy. NEOs are named executive officers, and they are the CFO, the CEO, and the three most highly compensated officers. NEOs will be determined by your legal department or by your SEC reporting group. The information you'll need to provide will be on grants, exercises, and releases, and will be presented in accordance with Proxy regulations, which may not always be intuitive, so you'll need your legal department or your SEC reporting group to help with this. In addition to individual information, there's a plan summary table in the Proxy that's divided into your shareholder-approved plans and your non-shareholder-approved plans. The non-shareholder approved plans are not very common anymore, but they used to be used, and it was they could only be used for new hire grants. So you may want to check and see if you do have any non-shareholder approved plans. In addition to providing the data, I suggest that you review the proxy if you're given the chance. You may be able to add value and find errors or points that could be improved based on your intimate knowledge of the equity at your company. Other helpful hints, I like to keep a folder during the year to record any changes to plans or policies that may need to be disclosed in the proxy. Also, I like to record any pain points from the prior year's proxy so that when it comes time to do it again, you don't have to reinvent the wheel. You can just go back to your notes and see what you did last year. And then the other thing is any Form 4s that are filed late will need to be disclosed in the proxy. And I believe that the reporting requirement is only on the number of reports that were late. I don't think you need any more details than that. Okay, so you may also be asked to provide data for forecasting income or cash flow on a quarterly or monthly basis. Items that may need to be forecasted would include cash inflows from option exercises, which is really hard to determine, but you can look at your past performance based on what your stock price is doing. And then ESPP purchases. Cash outflows would be for RSU tax withholding if shares are netted for taxes so that you're not having an inflow to cover the tax payments that need to be made. And also dividend equivalent payments. your financial reporting group will be calculating expense for equity. For options, they'll use a Black-Scholes model, which will include assumptions on expected term, interest rates, and forfeitures. And you may be asked for input on the expected term of your options. If your options have any market vesting conditions, then your accounting group will need to use a Monte Carlo model, which is even more complicated. So for restricted stock and restricted stock units, you'll use the expense will be based on the market value on the grant date. If you have performance vesting, an assumption will need to be made each quarter on the level of performance that's likely to be achieved, and then your expense will need to be retroactively adjusted when you change your level of performance. Performance vesting options or performance vesting RSUs are not reported on the Form 4, so that the change in your vesting assumption does not need to be reported on a Form 4. If your company pays a dividend and your awards don't have dividend equivalent rights, then the value of the award for expensing will be reduced by the present value of the expected dividend payments. Expense for an ESPP is calculated using a Black-Scholes model and treating each offering period as an option. Voluntary withdrawals, decreases in contributions, and automatic resets all cause additional complications for expensing, and hopefully your accounting group is handling that. Material modifications to any awards may lead to modification accounting, and once again, your accounting group will determine this. And that is all I have, and now we have time, a few minutes for questions.
Okay, thank you, Sally. We'll go ahead and move into the questions and answers. We have one for Catherine on the ESPP. Is it okay for the company to require ESPP shares purchased via a company-sponsored broker for the required holding periods?
That depends upon what is in the agreement, the enrollment agreement that the employee is signing up for. If you're going to require your employees to keep their shares, to hold them or sell them out of the captive broker, they have to agree to it when they enroll in the plan. If they didn't agree to it, or if it wasn't in that initial enrollment, then you can highly suggest it, but you can't require it.
Thanks, Catherine. We have someone here who I think is not so much asking a question, but is doing clarification on incentive stock options and non-qualified options, such as taxes are only due if ISO shares are sold, which is absolutely 100% correct, and non-qualified option exercises are taxed. ISO exercise is not taxed, that is correct, but it could be subject to alternative minimum tax.
Yeah, so the easiest way to remember that is with an ISO, the exercise of the stock option is not the taxable event. The sale of the shares is the taxable event. So even though sometimes it's confusing, you've got a same-day sale happening, yeah, there's a taxable event happening, and you're going to report the gain to payroll, but you're not going to have to withhold shares. But the event that's happening that's causing that is the sale, not the exercise. Many people use the word exercise to mean same-day sale, but that's actually that is a separate transaction.
Thank you for the clarification. I'm not seeing any more questions at this point. So does anybody have any other questions out there? Okay, let me move to our contact information here. If you think of a question or you need clarification after the presentation or at any time, you can see there's contact information for myself and Catherine at Stock and Option Solutions, and also contact information from Sally at KLA-Tencor. So if there is no other questions and we've covered our material for the day, I guess we have finished the webcast. And we thank you so very, very much for participating, and wish you all a nice day. Thank you so much.
Great. Thank you, Carol. I just would like to thank you and Sally and Catherine who joined us, and thank all of you for attending today's educational webcast. Please do look for an email in the next few days with links to the recording and materials. Thank you again, and have a great day. Bye-bye.